So Jericho Oil Corporation is a Vancouver-based junior oil and gas company. It trades on the Toronto Stock Exchange, TSX-V. The symbol is JCO. And the primary focus of Jericho is to look for opportunities in what we consider to be fractured oil and gas markets. And fractured oil and gas markets for Jericho mean opportunities where there are existing or known producing fields and the development and the production of those assets has been fragmented over the last 10, 15 years. You know, the opportunity being to look for what we would consider to be lower risk, higher margin producing fields. My responsibility at Jericho is on the operating side and the acquisition side. I have been in and around the oil and gas business now for just about 17 years, and specifically the last 4 of which has been acquiring and evaluating and drilling assets very similar to the ones that Jericho has purchased and is in the process of now drilling. So shallower oil fields that have high netbacks to the investor, with low exploration risk. And the target for Jericho is to grow a portfolio of these type of assets and to take the company from initially acquiring 2 sets of assets to eventually being a platform that produces 3,000 to 5,000 barrels of oil a day. And the idea is to bring new technology or modern day technology, techniques, and know-how to these long life conventional assets. And we look for strategies where we can essentially manufacture the oil. We look for opportunities where our margins are $40 to $50+ per barrel back at the pump. And so Jericho made its first acquisitions just this spring, and we have acquired 2 properties in Kansas, focused on the shallow fields of eastern Kansas, specifically the Cherokee and the Forest City Basin area. And so those acquisitions were preceded by Jericho's private placement. Jericho had raised $6.5 million. And that was done through a private placement, and that package included both shares and a half warrant with each share. And so post that raise, Jericho has 37 million shares outstanding, 11 million warrants. The current share price is right around 60 cents a share. Market cap is about $22 million, and the current production is 27 barrels a day with proven reserves, PDP reserves, proven developed producing reserves of 58,000 plus barrels. Jericho currently has about 3,100 acres in its portfolio to develop. Those acres are contiguous and proximate to each other within about a 40-mile span. And that is an important part of Jericho's strategy as we talk more about Jericho. So Jericho's drilling efforts all revolve around the existing producing fields. So all of the assets that Jericho has acquired and will seek to acquire have historical production or data regarding its historical production. And so the typical Jericho project will be to come into a given field, just like the assets that Jericho's acquired, assess the field, go in and do what are called reworks, bring online what has been currently or temporarily shut off, re-drill new producers, plug existing producers, and move to doing things in a more 21st century fashion. That can include everything from how we stimulate the wells to doing a 5-spot water flood program, which is a secondary recovery program, which is a prevalent part of the Jericho strategy. Prior to bringing Jericho into eastern Kansas, I drilled over 500 wells in this particular area. So the know-how and the skill set we developed during that period really drove the initial platform for Jericho. And so the idea is to take these legacy producing oil basins and focus on making them profitable, operating them at the lowest cost possible, and utilizing local talent. So one of the things that we have with Jericho is a local operating development team that works for Jericho. So these folks are there every day on the ground working on behalf of Jericho to develop, drill the assets based on the plans that we set forth. And we have found that to be highly effective to have that grassroots strategy, because what you see in these smaller, what I would call forgotten stripper well basins, is a local sourcing presence is a key ingredient to success. Access is key. You typically don't see bigger players coming in with institutional capital. Your typical competition is local mom and pop operators. And so we believe that the competitive advantage that Jericho brings is we bring institutional capital, but we marry it with that local operator presence and knowledge, which gives people a comfort level that we're going to be there every day and we're going to be good stewards of their land. And so this is just a little bit more looking at the North American, particularly the United States oil and gas market. What you'll see is the type of wells that Jericho focuses on are fairly prevalent. They represent 75 to 80% of the United States oil and gas wells. And you'll see we picked Kansas as our starting point, and that represents the 9th largest state in terms of stripper wells. And that will be Jericho's first platform. The idea is to expand Jericho's presence to have a second and a third platform over the next 18 to 24 months. And the goal will be to grow those platforms to 1,000 barrel a day producing set of assets. And so you'll see that our focus obviously will be Texas, Oklahoma, California, and areas where there's a prevalent stripper well presence. In each of these markets, the objective will be the same thing that we have established in eastern Kansas, which will be to have a local operating team that will be our eyes, ears, and development efforts on the ground. And they typically work exclusively for us, and they're highly incented, and both in terms of equity compensation in Jericho and then milestone goals based on cost, profitability, and sourcing in the local market. So as I said earlier, eastern Kansas represents the first platform for Jericho. When we acquired the initial set of assets, the idea was to immediately go in and assess what was the existing field. And the assets that we acquired, the leases that we acquired, were twofold in terms of the strategy. One is to make sure that Jericho received a high net revenue interest, which is something that we think is very important when you think about assets. And it's become something that has been decreasing over the last 18 to 24 months with landowners seeking larger and larger royalties. We make an effort to make sure that in each of the cases, the NRI that's acquired represents greater than 80% or greater interest. The initial package you'll see is very tightly located. It's within an hour's drive. It represents 24 leases, and that encompasses both the initial acquisitions and some subsequent acquisitions that we made based on our first phase drilling results. These properties are 3,100 acres within an hour's drive of each other. And when you're operating fields where you'll have a high number of well counts, operating expenses is a key metric. Our experience is that we can operate these assets at $15 per barrel, and in some cases lower. But we typically look to keep it to manage that to no higher than $15 a barrel And that's through having an institutional process for managing ongoing field operations. And by having an acreage package that's so tightly concentrated, it gives us the opportunity to really sort of minimize our costs associated with operating the assets. In developing the assets, our goal will be to go through a 3-phase process. So we typically look to do what we call workovers, reactivations, and stimulations. This is where we go back into old producers that have been put on time clocks, that may have been drilled with open hole completions, that may have broken down for one reason or another. It could be related to the infrastructure, and repair, restore, or even plug those existing wells, and to increase the initial production at the field level with those activities. The next step for us, and this is really why we call our development program a very low risk development program, is because we will typically look to step out from the existing producers or infill drill between the existing producers. We have found that after drilling 500 wells that the most efficient spacing is at about 2.5 acres or 330 feet. That is much different than what you would typically see. Most fields are drilled on 40 plus acre spacing. We found 2.5 acre spacing to be the optimal development program for our leases. And we've not seen any communication between the wells when we're drilling them at that distance. A typical well for us is about under 1,000 feet. Our formations that we're focused on in eastern Kansas are anywhere from the Bartlesville to the Cattleman to the Squirrel to the Peru formations, and all of them exist at sub 1,000 feet. So we typically can drill a well within a day and case a well within a day. And so in the life of Jericho, we acquired the assets in Q2, and we are now actively in phase 1 and finishing up our phase 1 drilling program. The majority of the wells we drill will be vertical. There are opportunities for us to drill horizontal wells, and we have drilled them in the past, but we have found the vertical wells to be the most cost-efficient way to access these reservoirs. The third and final stage is a bridge between phase 2 and phase 3 for us. So in addition to drilling new producing wells, we will commonly drill at the same time a series of water injection wells. And those water injection wells both utilize the existing fluid that the field will make and recycles it through, but it will also take in water that we will supply from a water supply well that'll be drilled to about 1,000 feet. And that is really sort of a key component of our strategy. These shallower fields typically lack energy, and we found that by bringing the water to the field almost initially, you expedite that process and you create a situation where you can create a second peak flow from the field. These fields typically will last 15 to 20 years, particularly at today's current oil prices. So they are very slow, long life cash flowing wells. Steady as she goes is the way we like to think of them. This slide shows how we develop a field. So what you're typically going to see from us is a crop looking structure. And as I said at the beginning, this is a very manufacturing institutional process that we deploy. Row by row, well by well. Our philosophy is to do it one well at a time. And so when you look at a field that has 3,100 drillable acres, there's the potential there for 1,000 drillable wells. And that is very different than what you would typically see in a shale type play. 3,100 acres, offers us tremendous development opportunity, whereas 3,100 acres in a shale play may amount to nothing more than a two well program. And so for us, the idea is to optimize spacing and focus on drilling, one injector for every producer we drill in that 5-spot pattern that we have become accustomed to and found to be the most efficient way to drill these wells. These are our typical well economics. And this is, numbers that are developed over about a 500 plus well program. And so for us, we have gotten the cost of a producing well down to $35,000. The cost of an injection well down to about $27,000. So for a pair, a producer and injector, you're looking at about $6,200. Your recoverable reserves from that well will be about 6,600 barrels, with a decline rate that's going to run you somewhere around 12%. And you'll see, so the present value for that pair is about $130,000. Now keep in mind, all of the economics, the present value, the reserves, and all those things were done as we do all of our modeling off a $90 oil. So at today's current prices, you're going to have a larger NPV number, and your payouts will be shorter and your IRRs will be higher. But at $90 oil, and you can see that to the right, that those numbers obviously change as you get up there. So if you look at today's prices, you're somewhere at 103, your economics push north of 60% internal rate of returns on our type of wells. And the thing that we find so comforting about them is that they're so consistent and steady. You're not going to see a lot of variability well to well in terms of the economics, in terms of the performance. Oil's as much an art as it is a science, so you do see a little variability, but in having drilled 500 of these, we see it to be a fairly ubiquitous, consistent performance metric. And so our targets are 50% internal rate of return per well, and most importantly, 50% net back to the company. And so post at a $90 barrel, royalties, taxes, OPEX, transportation, everything that goes on associated with that barrel, we will look to generate $50 back per barrel. Obviously today we're generating closer to $62, $63 back on a per barrel basis. And what's so exciting to me is these economics stack up against the best and better than some of the shale plays you'll see out there. You're not going to see the velocity of oil in ours, but you're going to see very high margin, very low risk per barrel economics. And one other key aspect to our operating plan, and this is a risk mitigation technique, because our wells are so shallow, we don't put ourselves in a position where if oil prices were to plummet, that we are at the mercy of those prices. We can always turn off our production, or we can shut in our drilling. It takes us 2 days to drill a well. So we never have a significant amount of capital deployed and unhedged in the ground. One of the things that you will see Jericho look to do once we finish our new program is to look to put some hedges in place to lock in the price for its existing production. Because you see all of our economics are based off of $90 per barrel oil. We think that it's a prudent strategy to try and hedge out some of our price exposure, since we're able to achieve a close to $100 per barrel price on a 12 to 18 month basis. You'll see, this is one of our set of assets here. They're made up of 4 counties, 3,100 acres. Total drilling depth is under 1,000 feet. If we do drill a dry hole, and as an investor and as an operating guy, we're always looking for the extension of the existing formation. So it is common for us to extend our known productive area, or attempt to extend the known productive area, either east, west, north, south, depending on where we're producing, and to attempt to drill some wells on the outer limits. And so it is common for you to see us spend a few dollars to look for that extension. The key is those few dollars on a dry hole basis are $10,000. And so we will typically try and extend the formations. We find it to be more cost effective than shooting a seismic shoot. And 3D seismic at our depths doesn't really offer a lot of data. Operating wise, as I said earlier, we've gotten our costs down to as low as $12 a barrel, but our economics that we propose are typically done off of $15 per barrel. And this is sort of where our assets stand. We have a high proven to probable possible reserve number. And that's the nature of our assets, because we drill in such tight spacing at 330 feet. We believe that we should receive multiple PUDs for each location off of as an existing producer. If we were drilling the same field in Texas, we would get 40-acre PUDs. So we believe it's appropriate for us to get at least 2 PUDs per producing well. And that's been the history that we've seen there. These are our charts and how we track time. So Q2, the quarter we're in, Q3 we're in now. We just finished Q2. Obviously, those numbers match what we acquired with a slight change in the production up a barrel a day. The idea being that that's what we bought, and Q3 we look forward to providing the results of our first drilling program. And as an analogy, while we were in the drilling program, we saw enough interesting data to opportunistically acquire some additional acreage. So we picked up contiguous acreage to some of our existing assets, and that was based on what we saw from the cores when we drilled the first series of wells. So we picked up both leases that are north and northeast of our existing fields based on the data we have in the field. So we look forward to, we've incorporated them into phase 1, and we are looking forward to releasing those results in the not too distant future. So just to recap on our strategy for Jericho, we focus on fragmented and fractured markets. And the way we define them and the way we look for them is where you have a high ratio of operators to production, and meaning that you have lots of folks producing a little bit of oil. In our experience, that means that you typically have smaller, more localized operators who typically don't bring institutional capital or an institutional development mindset to the field. Not that they're not profitable and productive, but they typically don't have the bandwidth to expand out a program. And we think that that's a key opportunity we capitalize on. All of our assets you'll typically see are long life conventional assets. And for us, we think that you can take those assets and do so much with them with all of the techniques, technologies, and know-how that exist in today's market. Most of these fields haven't been developed since the 80s. When oil prices collapsed, what we find is a lot of them have been left idle. And you just got to go looking and know where to look to find them. And 2 things that we think are key from a long life development perspective is repeatability of our strategy. Because North America is dominated by these stripper wells, these shallow wells, we think that our ability to grow from not just a Kansas producer to a 3,000 to 5,000 barrel per day producer is very real. And our intent is to do that in 3, 4, 5 platforms, each making 1,000 barrel a day as we grow the company. 2 key tenets that won't change no matter where we move the platform to is our focus on netbacks and margin. We believe that the goal should be to make as much money as you can per barrel, 1 well at a time, as opposed to a focus on velocity. So this is just more illustration of how we water flood. When you think of a barrel of oil, there's really 3 recovery phases. So you have your primary phase, you have your secondary phase, and then you have your tertiary phase. Primary production is just the initial energy, initial production from the well. The secondary recovery is, for us, that typically encompasses water flooding. And between the 2, you're still only taking out no more than about 40-45% of the in-place oil. Tertiary recovery is things such as CO2 floods, steam, things that will extend your recovery and add even another peak to the overall production profile of the well. And just sort of showing you how a water flood goes. The thing with a water flood and secondary recovery is that it's very hard to know what the timeline will be, because you don't know what the voidage space underground is that you're filling. And so for us, we found to be most efficient to drill our injectors as we're drilling our producers so that we expedite that process as much as possible. But what you don't want to do is overpressurize the field. If you overpressurize it, you have the opportunity for breakthroughs, which essentially minimize the impact of your water flood. What you want to develop is almost like a wall of water and push the oil through. This is just a little bios on Alan and Robin. Alan's been extremely successful in the public markets. He's had many successes in the resource space. He's the founder of Jericho Oil Corporation, and he's based in Vancouver, as is Robin, as is our corporate office. These are just board members on our team. Steve Kenwood, Nick Baxter, Jerry Tusky, all shareholders and board members of the team. That's it.